Hello and welcome to the check-in, episode 5, I think we're up to. It's great to have you part of the show again. Thank you for your loyalty. Thanks for dropping in every Sunday, Tuesday and Thursday night and for your comments as well. It's fantastic. Tonight is a pretty important show. It's all about money. It's all about your finances, your support from the government, what the government is doing to help us out in these crazy times. Over $200 billion has been spent by the Australian government or is being spent, which is an unbelievable amount of economic stimulus. But it's not really stimulating the economy, it's just keeping it on its wheels. So really great to have our guest Hamish Clark from Choice Capital joining us straight after the news. Hamish is a partner and senior financial planner. Hamish, welcome to the check-in.
Thanks, mate. Thanks for having me.
So, Hamish, we're going to talk money tonight and the economy and finances, superannuation. There's a lot to cover, and we'll try and get through as much as we can. Of course, for viewers on Facebook, if you do have any questions, please shoot them through. We'll endeavour to answer as many as we can as we go tonight. Hamish, I'm just going to bring up on the screen a couple of notices from today. Treasury announced that Australia is poised for double-digit unemployment at around 10% by June. That equates to about 1.4 million people. And they were saying that without the JobKeeper program, it could be around even sort of 15 to 17%, which, you know, those numbers are huge. Tell us put that in context. I mean, around the GFC, what were we at around then? Can you remember?
At the GFC, at its height in 2009, I think we barely got to 6.5%. So getting to close to 10% is huge. So that hasn't been since the early 90s in that sense. So it's definitely in unprecedented territory in the last 30, 40 years.
Wow, that's it's scary to think that without JobKeeper we'd be in, that
Worse
situation. Yeah, it's I mean, thank goodness we have that support from the government right now. There was some other news as well in terms of the tax reform. So the head of the Tax and Transfer Policy Institute, Robert Brunig, was calling this morning for new tax reform measures to ensure young Australians aren't left with the bill. He says that tax reform could reduce the economic recovery from 10 years to 5. Frydenberg, our treasurer, rebutted very quickly, saying there's no way in hell, basically, that he's going to be touching the GST. Talk us through that. I mean, who is going to be paying for this? Obviously, it's people that are still in their prime and still working and able to afford potentially some further levies or taxes. Retirees won't be. So baby boomers and beyond are probably not going to feel the pinch of this. What does it mean for the average punter? How do we pay this huge debt off?
It's a very, very interesting question, and there's a simple answer to it, and I'd probably suggest that despite all the news headlines around 200 billion of stimulus and spending and record debt and who's going to be paying it off is correct. It's not going to be the retirees because they're not going to be around for long enough, and if they've got a good financial plan, they're probably not paying any tax anyway. So but some reassuring things around that is that yes, it's 200 billion of spending we weren't planning to spend a couple of months ago, but we have seems like a lot. But in historical terms of Australia, we had greater levels of government debt in the early 90s, and at that time we also had significantly higher interest rates. So it sounds like all these stimulus measures and 200 billion of spending and all this debt that we need tax reform to pay off is huge. But the key thing about it is that Australia's population has significantly grown and interest rates are so low. Despite all this spending, the interest payments on that debt is not significant and is not as high as what it was in the early 90s. So yes, it's a lot of money that we've suddenly found ourselves in debt from, but it's nowhere near the record levels of debt that other countries around the world have, and it's definitely not the end of the world that's going to see significant increases in tax or warranted.
As you were saying before, Hamish, cash has never been cheaper to buy, and it's unfortunate that this pandemic has happened when it has. I know a lot of friends who were looking at buying, some of them buying into the property market for the first time. They had the funds available, ready to go. They had approval from the bank. Then this came along, and in fact, one of my friends actually still had to go through with the purchase just last week. But obviously, it's a hard time for people who maybe had the wherewithal to invest either in property or shares or something, but now they're unable to. What would your advice be? And I guess we've got to tread carefully in terms of providing financial advice specifically. But are there any opportunities for people to invest right now, or is it a blanket no across the industry?
Oh, definitely. I think these sorts of massive disturbances in economies provide significant opportunities to invest, whether that's business expansion, if businesses are able to, or both as individuals, if we're sitting in a very strong financial position, sitting on a lot of cash and being able to ride through this quite easily, there's definitely opportunities to pick up assets at heavily reduced prices, at least with the share market currently alone. And look, potentially depending on how long this drags out for, then that will also impact on the property market. So and these sorts of periods when assets, businesses, shares, property, etc., are significantly devalued, will ultimately recover and history repeats itself. So it's those that are able to strike in these times that will ultimately reap the greatest reward.
I was looking at the Dow Jones index and the ASX today, just looking at some of the graphs. I'm not a trader. I don't really understand that world all that well, but just looking at the graphs over a 5-year period, which obviously includes the big dip in 2015, 2016, I think when we had the oil price issue going on then, we're already at that level, and that was causing a lot of heated debate in terms of whether we're going into recession or not. And I kind of feel like with this pandemic, we're only just starting. Do you see the stock market? And we had a question from Julian asking, what, I know it's crystal balling a little bit, but what do you see happening to the stock market in the next 3 to 6 months?
Very good question, and it's funny that we're sitting here and about halfway through April, and share markets across the world in around about the 20th, 22nd of February were basically at all-time highs in Australia, in America, etc. And as soon as the virus news sort of came into being, it's effectively the quickest fall and the greatest fall in the shortest period of time in stock market history across the world. So the share markets and investment markets tend to overreact quicker, and they tend to react a lot more on sentiment and the way people feel about what's going on around them, maybe not necessarily about the true fundamentals and true facts about what's going on. So share markets have fallen 30-odd% to where they are around about today. So they've effectively priced in a recession. They've priced in that companies are going to be not making as much money and all those sorts of things. But until there's some form of certainty around the virus becoming under control around the world, and that being the catalyst to allow economies to get back to as much of normal as possible, then the share market will probably continue to bounce around. This is both Australia and around the world, will continue to bounce around with significant levels of volatility of, anywhere between 5 and 12% a day movement we're seeing up and down. And it will continue to do that up and down until there's some form of clarity and long-term outlook. So, but the key thing to understand at this point in time is from where it's fallen to where it is now, it's priced in a decent recession.
So what, if we can ask this question, what would be a good investment strategy right now? Is it looking at commodities? I saw today that frozen orange juice is the best performing. I don't even know what that is, but I guess you buy it in the freezer in the US or something. But that was the best performing commodity on the market. Should that be where investors are looking, or tech startups or biotech? Any thoughts on that without providing too much financial advice?
Another good question. And I guess it really depends on the investment time frame you're looking at. And if I can talk broadly across the market, the question to be asking yourself is, based on where the market in general is at today and where the economy is at in general, if you or the investor looking to invest, or I, at this point in time, were to believe that the market and companies would be worth more in 1 year, 3 years, or 5 years, whether it's in commodities, whether it's in tech or banks or anything, worth more in 1, 3, or 5 years than what it is today, then a diversified approach across a range of different sectors, be it commodities, banks, healthcare, etc., would be a good strategy. If you're looking to take advantage of trends or profiting in a very short period of time, then it would be very hard in this market to back a single sector, because the whole market is just bobbing up and down on confidence and uncertainty more than the underlying long-term view of that industry.
One of the first questions that myself and my wife had, very early in this pandemic was, what about our super? We've obviously worked very hard to build that up over the years, and it is tied to the stock market.
Indeed.
And at our age, I'm mid-40s, I've still got working years ahead of me to see the recovery. But that is a question that it's very disconcerting, I guess, thinking that your super level is, going from here down to here very quickly.
Now, it's a good question, and it's a question a lot of people have front of mind at the moment. And the key thing to bring that back to is, as you rightly said, it's all about your investment time frame. So if you've got 10, 15, 20 years before you can legally access your money, let alone you need your money for ultimate retirement, then short-term 1 or 2 year events like this or the GFC, we'll see a sharp drop, but we'll also see a tremendous recovery soon afterwards. So that being said, with a 10, 15, 20 year investment time frame, it will ultimately look like a small blip on your long-term trend line up. The mistake you can end up making is see it go down and down, sell it to cash, sit on it, miss the recovery, and then buy back in once the market's fully recovered and there's confidence around it, because you've missed the market. So
yeah,
it's not a pretty thing to look at. But if I can leave you and the viewers with an analogy, if you were to sell your property right now and you thought it was worth 500,000 before this, and someone was willing to offer you 300 today, would you take the 300, or would you just say, I'm sure it'll be worth more in 5 or 10 years, and just leave it?
Which leads me to the next question, and quite a few viewers might have this same question. There is the option from the federal government to withdraw I think, two tranches of $10,000 from your super, one now and one in May, I believe.
Yep.
What's your general view on that? Is that something that should only be left to sophisticated or just highly desperate people in their own financial situations? Obviously, it makes sense to get financial advice around that, but I know there are a lot of commentators in the media that are saying do not even think about touching your super. Others are more open. What are your thoughts?
I'd definitely strongly be in the camp of use that as your ultimate last resort. And there's plenty of other stimulus measures around which we could talk about in a minute to assist first. And the reason I would suggest that it's your ultimate last port of call is because if you're withdrawing $10,000 today, as we've just talked about, investment markets are 30 or 40% down. So you're selling out $10,000 of your super at significantly less share values or investment prices as it was a couple of months ago. And ultimately, that $10,000 is what that might look like at your retirement might actually be $20, $30, maybe $40,000 by the time you hit retirement of the true cost of that $10,000. So, and multiply that by 2 if you take 2 amounts out. So, I definitely I wasn't in favour of it when it was announced because it's super is meant to be a truly for your retirement, and if you can let it sit there until retirement, it will be fine. But because it has been made available, I would suggest that it should be anyone's absolute last resort.
Leading on from that, obviously thinking about the people who are facing financial difficulty, and maybe this needs a little bit of clarification because I'm still a bit confused. I work in the advertising and film industry, and a lot of my friends are casuals. A lot of the people that I employ for our business are casuals. Is there support for casual workers? Because it seems very unfair if a lot of these people aren't able to access anything.
Good question. And look, the short answer is yes. There's definitely support out there, and 2 types of support for casuals, or even sole traders. Now, the unfortunate thing is with all of these stimulus measures, there are groups of people that have fallen through the cracks. So just talking generally about casuals, they could be eligible for either the JobKeeper or the JobSeeker stimulus packages. The JobKeeper, if they're first and foremost, if the business that they work for is eligible, so they would need to check with their business if the business is eligible for that, and if they're casual and they've been working for that business for more than 12 months, then they could be eligible for that $1,500 a fortnight wage JobKeeper wage supplement. Otherwise, if they're casuals, be it in the film industry or the advertising industry or hospitality, etc., and they've completely lost their job, or they've lost a huge amount of their shifts, then the JobSeeker stimulus package, which is released by Centrelink, which was previously Newstart, has been made available to people who aren't fully unemployed. So casuals who have between them and their partner, if they have one, who have less than $79,000 of income between them per year, or if they're single with less than $1,075 per fortnight, would be eligible for somewhere between $500 to $600 a fortnight of the JobSeeker payment, and the $550 flat coronavirus supplement. So, as I said, there's a large group of people who are falling through the cracks. Like New Zealand citizens that live here that aren't permanent residents. They might be casuals, and they're not eligible for this. So it is there, but yes, unfortunately, some people are falling through the cracks.
And hello to all my New Zealand friends working in Australia or not working in Australia right now. Um, I received a text message today. Yay! JobKeeper payment update. The Australian government has now introduced the JobKeeper payment, so it is official, and inviting me to log into JobKeeper. There is no need to call us. I love how they always end their text messages with that little tip. But that's good news, and I believe from April 20, as an employer, you're able to log in to JobKeeper to register and start those payments. Do you know how quickly the payments will actually be made?
That's still slightly vague. To my understanding, is it will be if there's a significant delay, it will be backdated to the point of the start date, April 20. So how quickly it gets rolling, I think also the emphasis also falls on respective employers to make sure that they go through the relevant process of being made sure that they are truly eligible to get it. And once they've gone through the process, then they can start receiving the money to then pass on to their employers. So there's probably a fair bit of emphasis on people's employers.
Yeah. Come on, employers. Obviously, the government stimulus package has a finite reach, time-wise and population-wise. Have you seen any modelling around what happens once this $200 billion is spent? If the virus continues and if we don't take strong enough measures, or if it bounces back after we do. Have you seen anything that sort of suggests what we're going to do then?
Good question. And there hasn't been any official modelling released that truly gives us some concrete numbers around this. But according to the government, they've said that once all these stimulus measures have been exhausted and they've run their course, which I think will last between 6 and 9 months, then there won't be any other significant stimulus measures post this. So, to the question, if the virus continues to spiral out of control, or if we get it under control, we start easing restrictions, and there's a significant re-emergence of it, and that coincides with the time that these stimulus measures have finished, then we could be in much more dire straits than we find ourselves in today. So, but maybe the crystal lining in that, silver lining, and hopefully a vaccine around that time might be there to save the day. But to your question, Canberra have made it very clear that once these stimulus measures run their course, then that's it.
Yeah. Any final comments, mate? Just in terms of what you're seeing right now, the questions that you're getting from your clients, is there a sense of optimism at all? Is there are you seeing the silver lining?
The silver lining, I would suggest, around that, and a reason to be optimistic about the current situation, is that the situation in the Great Depression was caused by, to keep it simple, similar things that caused the GFC, which is not what is causing this downturn and economic environment. And the Great Depression was bad, and then was made significantly worse because the governments at that time didn't reduce interest rates, which made the cost of borrowing cheaper, and they didn't release stimulus packages like wage subsidies or ability for people to access money for a good 2.5, almost 3 years. So, and they were the worst years of the Depression because money was very hard to get. So people had no other choice but to live on the streets and steal and beg, which is the images of the Great Depression we can think about. So globally, that couldn't be further from the truth as to what we're seeing today with the coordinated stimulus packages and around the world of countries trying to keep businesses going, trying to keep employees or people financially stable, not stimulated, but just stable, just to be able to hibernate through this period, so that provided we can get the virus under control and return to life as much of normal as quickly as possible, then there won't be any significant damage. So I don't think we're anywhere close to seeing a huge depression like we did in the late 20s, because we've done exactly the opposite this time as to what happened then.
Hamish, thank you for your time. It's been fantastic, very informative, and really appreciate your insights there. It's answered a lot of my questions, and hopefully for the audience as well. Yeah, thank you for being part of the check-in, mate. We'll probably check in with you again a little bit down the track, just to see. Hopefully that silver lining is still around the clouds above us, and we're looking in a better shape financially. But appreciate your time tonight, Hamish. Thanks, mate.
Always a pleasure. Thanks for having me.